OpenAI missed its revenue targets, it missed user targets, and according to reporting from Data Center Dynamics, it is actively reworking its commitments under the Stargate joint venture, the $500 billion infrastructure program announced with SoftBank, Oracle, and the White House camera roll in January, while simultaneously preparing for a public offering. Now, if you've been watching the data center trade from the outside, your instinct might be to treat this as a tech company execution story, guidance slippage, growth stage turbulence, nothing structural. That instinct is wrong, and it's going to cost people money. Here's the institutional red most people are missing: a non-trivial portion of the new data center supply that broke ground in 2023 and 2024 was underwritten, explicitly or implicitly, against AI demand that was modeled as if it were sovereign. Hyperscaler capex commitments were treated like triple net leases with investment-grade tenants. They were not. And when the anchor tenant starts renegotiating before the building delivers, you don't have a tech problem. You have a real estate credit problem. What I'm watching now is a bifurcation, institutional grade, multi-tenant colocation with diversified contractual cash flows is going to hold. Single-tenant build-to-suit deals underwritten to one AI company's last fundraise valuation are going to get repriced, some of them hard. The question for anyone allocating capital into this sector right now, including people bringing deals to me, is which side of that line you're on. The data layer. Let's put numbers on the table, because the bull case for data center as an asset class is real, and I'm not dismissing it wholesale. According to JLL's 2024 Global Data Center Outlook, total commissioned capacity in primary North American markets, Northern Virginia, Dallas, Chicago, Phoenix, Silicon Valley, Atlanta, crossed 5,000 megawatts for the first time. Net absorption in Northern Virginia alone was approximately 2,700 megawatts in 2024, which is the largest single market absorption figure ever recorded for the asset class. CBRE's mid-2024 data center report put overall North American vacancy below 3% in Tier 1 markets. Those numbers are accurate, and they explain why institutional capital poured in. What those numbers don't show is the composition of demand. A significant share of that absorption was driven by pre-leases and letters of intent from AI-focused tenants, OpenAI, Anthropic, Zay, Inflection, and smaller names you haven't heard of, who signed based on training compute projections that were themselves based on scaling assumptions that are now being stress-tested. DeepSeek's R1 release in January 2025 was a forcing function here. When a frontier model matches GPT-4 class performance at a fraction of the compute cost, every CFO running an AI lab goes back to their infrastructure spend model. That's not speculation, that's what the renegotiation pressure at Stargate is. On the transaction side, Real Capital Analytics track data center cap rates compressing from the mid-5s into the high-4s and even sub-4 range for long-term lease assets with hyperscaler tenants through 2023 and into early 2024. Green Street's data center coverage flagged in Q3 2024 that the implied cap rates being paid in private transactions had disconnected from public market comps. The publicly traded data center REITs, Equinix and Digital Realty, were trading at implied cap rates 75 to 100 basis points wider than where private deals were clearing. That gap is a warning sign. When private markets are paying tighter than public comps for the same cash flow type, either the public market is wrong or the private market is underwriting something that isn't there. In this case, I think a lot of private deals were underwriting occupancy assumptions and rent escalations that assumed perpetual AI demand acceleration. That assumption has a crack in it now. For the single-tenant build-to-suit deals specifically, the structures where a developer or sponsor commits to a purpose-built facility and an AI company signs a 10 or 15-year lease, the credit quality of the tenant is everything. These are not like an Amazon or Microsoft hyperscaler deal where you have an investment-grade balance sheet with $80 billion in operating cash flow backstopping the obligation. OpenAI, as a cap-profit entity converting to a for-profit structure, has not yet demonstrated the revenue density to service the infrastructure commitments it's made. Their reported 2024 revenue is approximately $3.7 billion, against operating losses rumored to be in the $5 billion range. That is not a balance sheet you underwrite a 15-year, $400 per square foot build-to-suit against without a very serious look at the guarantee structure, the security deposit, and what happens to that lease if the IPO gets delayed or the cap raise doesn't close on the terms currently projected. The mechanism. Why is this happening now specifically, rather than 18 months ago when some of us weren't already asking these questions? Three things converged. First, the compute efficiency shock. DeepSeek demonstrated that inference at frontier quality does not require the compute density that the 2023 and 2024 capex plans were built around. If inference per dollar improves at the rate some researchers are projecting, the megawatt per revenue dollar ratio for AI companies improves, which means they need less power capacity for the same revenue output. That doesn't kill demand, it reshapes it and it slows the growth rate of absolute megawatt absorption. Second, the IPO constraint. OpenAI moving toward a public offering means its financial disclosures are about to become a lot more rigorous. A company preparing for public markets cannot carry $500 billion in infrastructure commitments on its forward obligations schedule without institutional investors asking very direct questions about payback period and free cash flow conversion. Renegotiating those commitments before the S1 lands is rational behavior. It is also, from a real estate perspective, a material change to the demand signal that was priced into recently originated deals. Third, the debt maturity wall in construction lending. A significant number of data center construction loans that were originated in 2022 and 2023, when 12 to 18-month SOFR plus 400 bridge structures were the standard, are coming due or have already been extended once. Lenders who were comfortable at 65% LTC on a pro forma stabilized asset are getting a lot more conservative when the anchor tenant is restructuring its commitments. That creates forced seller dynamics, and it creates basis reset opportunities for equity that comes in with clean credit and realistic underwriting. Where mid-market capital fits, the segment I'm focused on is not the $1 billion plus hyperscale campuses. That's a different business. It's development finance at a scale that requires balance sheet I'm not deploying at this stage, and the tenant concentration risk in that format is exactly what I'm concerned about. The segment that's mispriced for capital moving sub $100 million is multi-tenant edge and secondary market colocation. Here's the specific structure: facilities in the 5 to 30 megawatt range, located in secondary markets. Think Columbus, Salt Lake City, San Antonio, Kansas City, where power costs are in the 4 to 6 cents per kilowatt hour range versus the 8 to 12 cents you're paying in Northern Virginia or Silicon Valley, where fiber interconnection exists but land and construction costs haven't been bid up to primary market levels, and where the tenant base is a mix of regional enterprise, managed service providers, and government workloads that have 3 to 7 year leases and actual operating history. This is not the AI training compute story. This is the distributed compute and data sovereignty story, which has its own demand driver that is not correlated to OpenAI's revenue trajectory. The deal structures I'm looking at in this segment are sale-leaseback opportunities from operators who built the asset with their own capital and need liquidity, preferred equity positions in recapitalizations where a senior lender is haircut, motivated to reset the cap stack, and direct acquisitions at cap rates that have widened back into the 6.5 to 7.5 range for assets with 70% plus occupancy and no single tenant above 30% of revenue. Those numbers are available today in secondary markets. They were not available 18 months ago. Counter positions and risks. I want to be direct about what the bulls get right, because I'm not making a macro bear call on data center. Power constraint is real. The utility interconnection queue in the United States is genuinely 3 to 5 years in most markets. That creates supply scarcity that supports existing assets independent of tenant mix. If you own a powered facility with interconnection agreements today, that asset has intrinsic value that is not easily replicated. The sovereign AI dynamic is real. Microsoft, Google, Amazon, and Meta are not OpenAI. They have investment-grade credit. They have multi-year capex plans that are publicly committed, and their leasing activity is not subject to the same fundraise cycle volatility. If your deal has a Microsoft or Amazon anchor on a 15-year lease, the OpenAI story is largely irrelevant to your underwriting. The inference build-out is also real. Even if training compute efficiency improves dramatically, inference compute, the servers that respond to every ChatGPT query, every Copilot autocomplete, every AI-assisted search result, scales with user adoption, and user adoption is still growing. The demand for inference infrastructure is not going away. It may be shifting to different hardware configurations, but it still needs power and cooling in physical space. The risk I'm genuinely concerned about is the vintage of deals that were done in 2023 and 2024 at sub-5 cap rates with AI company tenants who have no public balance sheet, no operating history at scale, and commitment structures that look like LOIs with development conditions rather than binding leases with credit-worthy guarantors. That paper is going to have a difficult 18 to 24 months. The position I'm taking. Right now I'm actively evaluating two types of opportunities in this sector. The first is secondary market colo acquisitions in the 8 to 25 megawatt range, specifically in markets where I can verify the utility interconnection position, where occupancy is at or above 65% with no single tenant above 25% of revenue, and where the ask is in the 6.5 to 7 cap range on trailing 12-month NOI, not forward modeled, not pro forma, trailing actuals. I want to see the metered power draw, the lease roll schedule, and the interconnection agreement before I look at anything else. The second is preferred equity or structured first loss positions in recapitalizations where a developer built a legitimate asset, good location, real power, real fiber, but over-equitized or over-levered on construction financing that's now due. If the asset has contracted cash flow and the cap stack just needs to be reset, there's a role for structured capital at a blended yield in the low to mid-teens with asset-backed downside protection. I'm not underwriting the AI demand story. I'm underwriting the existing contracted revenue and the replacement cost of the physical plant, which in most secondary markets is still 30 to 40% above where you can acquire existing stabilized assets. What I'm not doing is writing a check for a new ground-up, single-tenant build-to-suit where the anchor is an AI company whose last valuation was set in a private round and whose balance sheet I can't independently verify. That deal structure requires a level of credit diligence on the tenant that simply isn't available for private companies at this stage. And the OpenAI news makes clear that fundraise valuation and contractual commitment reliability are two different things. Close. OpenAI missing targets doesn't end the data center trade. It ends the version of the trade that assumed AI capex commitments were as bankable as investment-grade leases. They aren't, and they never were, but a lot of deals got done as if they were. The bifurcation is now. Diversified, multi-tenant, contractually stabilized assets in power-constrained markets hold their value. Single-tenant, build-to-suit, AI-anchored deals that haven't been stress-tested against a slower revenue ramp get repriced. If you're an operator or a broker bringing me a data center opportunity, the first question I'm asking is simple. Who is the contractual tenant? What is their audited balance sheet? And what is the guarantee structure? If that question has a clean answer, let's talk. If the answer is a cap table and a term sheet, come back when the credit is clearer. DM me at @BrodyOfficial. I root everything personally.